Funding for Market Journal is provided by the Nebraska Corn Board.
Growing more with less is the mantra of Nebraska's corn farmers, and they're using incredible technology to do it. Soil moisture monitors let them know when their crop needs water and how much. GPS systems eliminate overlaps in the field, saving fuel and money. New hybrids reduce the use of pesticides and increase yields. When you're talking new technology and innovation, Nebraska corn farmers are all ears. Nebraska's family corn farmers, sustaining innovation.
Market Journal, television for agricultural business decisions, is a presentation of the University of Nebraska-Lincoln's Institute of Agriculture and Natural Resources. Promotional support is provided by the Nebraska Farmer Magazine, and major funding for Market Journal is provided by the Nebraska Corn Board.
Welcome to this week's edition of Market Journal. I'm Jeff Wilkerson. On this episode, Chad Hart looks at price movements for corn and soybeans. Scott Brown describes profitability for U.S. dairy producers. Tina Barrett discusses tax planning, and Allan Vyhnalek talks about land prices. Iowa State Extension economist and crop market specialist Chad Hart is our corn and soybean market analyst this week. The U.S. soybean harvest is now more than 3/4 complete and on pace with the country's 5-year average. Corn harvest is 61% finished, just a point behind normal. Iowa, Nebraska, and Minnesota are among the states trailing their regular corn harvest paces, but Illinois and Indiana are further ahead than usual. Heavy rains moved through portions of the Midwest, including Iowa, Tuesday night into Wednesday. We started by asking about harvest progress there when we talked with Chad Thursday morning.
Harvest progress here in Iowa, it's been a slower harvest than we'd normally like to see. The rains through most of the late summer, early fall here did slow us down, but we're starting to catch back up. Over half the corn and soybean crop has now been brought in for harvest, and so when we look from a nationwide scale, we're about where we should be at this time.
Too early to get a sense on yields?
On the yields, we're seeing, I would say this, the discussion I've been having with farmers is as they look at the corn crop, a lot of them say it's a good one, even a great one, but not quite as strong as what they saw, say, for example, 2014. So, farmers are saying that they expect the USDA yields to come back a little bit. But as we look at the soybeans, the idea is that rain did help fill out those pods. We're definitely staring at a record yield here in Iowa for beans.
Let's start in soybeans as we look at both crops. Expectations of a record crop across the country. No real major harvest delays, and yet we've been able to put some money onto this market. Diagnose what's happening.
We have been able to add some money onto the soybean market, and it's been demand driven. I think when you're looking here, the key has been exports, and specifically exports into China. The idea is China has ramped up their purchases from the U.S. We're up about 25-30%. From China compared to last year, and so that's helping show that the demand is still there for soybeans, especially from the international marketplace. And when you look between corn and soybeans, soybeans has been the tighter crop where we haven't had as much storage buildup, and so this export pull continues to help push soybean prices higher.
With that tight storage concern, would you like to be a seller here for soybeans at all?
With soybeans, I'm not necessarily wanting to move them right away unless I have to, but as I look out, what that does offer is as we go into springtime, I think we could see a sizable pop in soybean prices, sort of like we did this past year if you think about it. It took a while for soybeans to get there, the soybean market for it to get its legs underneath itself. But once we got into March, April, May, we saw a good, strong run-up in prices, and I think we're setting ourselves up for that again as I look into 2017.
Corn hasn't been quite as positive as soybeans, but are you encouraged at all by the good days that we have put in?
I am encouraged by the corn market because, again, when you're wrestling with a record crop, and in this case, you're talking about 15 billion bushels of production combined with what we've got in storage, we're sitting on over 16.5 billion bushels of corn coursing through the marketplace, and yet prices are holding in there. And again, it's because of the demand we've got for the crop. When you look at the livestock industries continuing to grow, that's helping build up feed demand. Ethanol continues to basically push forward at record levels. We've been seeing more enter into the sweetener market, and also exports again have been strong. When we look here, both corn and beans have seen a resurgence in that international demand. That bodes well for these markets as we look forward. The problem that we're having is just the large supplies, the record supplies, as you mentioned here, sort of overwhelming the market here at harvest time. Things do look better as we look out 6 to 9 months.
So you're thinking maybe wait on selling there as well?
Yep, I'm definitely looking to see if I can hold and store here. I know there's been a lot of discussion from farmers about, for example, using the marketing loan program to give themselves some cash flow now, but then be able to market the crop a little later. And so that's what a lot of farmers are exploring right now, is that they're looking to store the crop either on farm or commercially, try to target those higher prices as we look into springtime.
When we last talked in July, we talked about crop margins. You've updated those now for both 16-17 and 17-18. How do they compare?
When you're looking at 16-17, the issue had been when we looked compared to production costs, this crop had always been running behind. The thing that sort of saved us here this year is that extra production, those record yields that we're having now. That helped, one, lower our production cost per bushel, but it also gave us more bushels to sell. And so soybeans is actually coming in almost break even as we look at the 16 crop. Corn still a little bit below break even, but the whole is not nearly as bad as it once was. But looking forward into 17, the markets, while improving, are still showing prices that are below our production cost. And so the market knows we're still wrestling with a lot of supply. The market is reflecting the stronger demand, but it's just not strong enough to take us back to those break-even levels quite yet.
Okay, we'll close out with this. We're almost through the discovery period for the harvest price option. What does it look like?
When we're looking at what we're seeing on the markets right now, the problem is they're almost where when we set the projected price for our crop insurance was. If you think back to it, the idea is for both corn and soybeans, you're looking at that February average on the harvest contracts to set the price, and then you look at the October average on those same contracts to finalize the price for crop insurance. Well, it's been sort of a wash. We've had a lot of movement of price in between, but the idea is we're basically back to where we started in terms of those futures market prices. So for those looking for a crop insurance payment, it means you'd have to suffer a yield loss to get there. Given the bumper crops that we're seeing, there are not going to be many farmers staring at that situation.
Next week, Oklahoma State Extension livestock marketing specialist Daryl Peel will join us to analyze cattle markets. While low prices are pressuring producers, the U.S. dairy herd is growing to its largest size in 20 years. The U.S. Department of Agriculture is forecasting an increase in the number of milk cows through the third and fourth quarters of 2016 into the first and second quarters of 2017. Annual demand for dairy products in the United States has flipped over the past 40 years. Per-person milk consumption in 2015 was the lowest on record, with data dating back to 1975. But the average American is eating more butter and more cheese than ever before. Over the past few months, the USDA has stepped in twice, announcing cheese purchases of about $40 million. It said in August the cheese surplus had climbed to 30-year highs. Scott Brown is an extension ag economist at the University of Missouri. We spoke with him last Friday about U.S. milk production, risk management for producers, and the current profitability environment across the country.
I think when you look at 2016, it's been a very tough year. Milk prices certainly fell as we entered 2016, and we've continued in a situation where milk prices for most folks around this country have not allowed them to break even, so it's been a very tough financial year for producers thus far. And although we have gotten some price increase the last 60 days or so, we're still seeing a lot of stress out there, especially in some parts of the country. I'll say the Northeast in particular, where drought coupled with what's been lower milk prices has made it a pretty tough road for many of those producers.
How has productivity contributed to this oversupply?
Well, it's certainly been a big part of what we've had happening in 2016 with milk yields that continue to be 1.5% above a year ago levels. For many producers around the country, it has put more supplies of milk on the marketplace, and frankly, we're just full in a lot of places around the country, and finding that home for the last trailer load of milk gets pretty tough, and sometimes that has meant some pretty low prices as milk has to move at pretty distressed levels.
That most recent milk production report, does that echo that?
It absolutely does. You know, it's amazing when you look at the milk production report that we just got out. You have states like Texas, South Dakota, Michigan, I think plus a 5% milk production growth relative to a year ago out of the last report. It is amazing that we're continuing to get the advancement in milk supplies in 2016, despite what's been a pretty tough year from a profitability standpoint. We've had a very tough time getting producers to turn off that milk spigot in these lower returns, and milk yields has been a big part of that.
Why is it so hard to get them to turn away from that, Scott?
I think when you look at this, the structure of the industry that we have today in the dairy side, we certainly have a lot of folks who have no option. They're either going to produce milk until the bank tells them they can't, and there's really no alternative. And even if we see some of these larger operations that go out of business, they tend to be sold for cents on the dollar, and they keep producing milk. And so I will continue to say one of my very large concerns for dairy producers across the country today is that we're just so unresponsive to low returns. And that's certainly the case today. And if you look at USDA right now, they're saying we're going to have 1.5% to 2% milk production growth for much of 2017 as well. And if we continue that pace, I'm worried about what milk prices look like for producers going into next year as well.
If you look at the USDA stats on per person consumption of dairy products, milk is at an all-time low going back to 1975, but Americans are eating more cheese and butter. What does that mean for demand and the environment for dairy products?
Yeah, so thank goodness we have that demand growth in places like butter and cheese. I joke all the time about where do we find the next place to put cheese on a pizza. We've got it in the crust, more on top of the crust. I worry about the day that cheese demand slows from what's been a very good picture the last few years. Butter's been the other side of that, where we've seen a lot of manufacturers or those making products turning back to butter for that fat in their product, consumers liking the taste. Those things have been very helpful. If any of those were to falter, especially given what's been an export market that's been a little tougher to deal with a stronger dollar, domestic markets have been much more important to us, and we can't grow milk production if we don't see those kinds of growths in things like butter and cheese consumption in this country today.
Let's close out talking about risk management. How much support might producers get from that margin protection program?
Yeah, I think when you talk to producers today, they'll say they get very little support from the margin protection program that we passed in the 2014 Farm Bill. That they feel like it's been a very stressful year here in 2016, and unless they had bought up substantially in terms of coverage, they aren't getting payments. I think when we passed the Farm Bill with the margin protection program in it, none of us would have ever thought we were going to talk about $3 corn. And so feed costs have come down considerably for many producers on the dairy front. And some of them who are actually producing their own feed instead of buying their own feed have really not seen production costs for growing that acre of corn silage or that acre of corn go down hardly at all from the peaks of corn prices that we saw a few years ago. And so I think the MPP margin has missed where really actual feed costs fit for many of these folks. But for right now, I think many in the industry are looking for help in terms of risk management. Perhaps that's something that lays the groundwork as we look ahead to the next Farm Bill, whether that's 2017 or beyond, in terms of how do we make a better risk management product for producers in this country.
As Scott mentioned, milk production in September was up from a year ago. Production per cow was the highest for that month since data began in 2003. At the end of November, the USDA will update its forecast for 2016 U.S. net farm income. The current forecast of $71.5 billion is more than 42% lower than the record farmers and ranchers set only 3 years ago. As producers go through the tax planning season, Tina Barrett from Nebraska Farm Business, Inc. says that slide could now be more noticeable. We talked with Tina recently and started by talking about how this year might be different.
Well, I think this is going to be the first year that we're really seeing some of those accrual net farm incomes drop off, which means people are going to feel like they haven't made a lot of money. And I think it's really important that we don't forget tax planning in a year when it's low, because it can almost be more important than when it's high income time.
You want to go a little bit more on why cash might be low, but perhaps you've already spent some?
Sure. So there's a couple big things. The big issues of taxable income might still be high even though you don't have any cash left would be family living, because it's not deductible, and principal payments, which are not deductible. So we know family living's been on the rise. Haven't seen a whole lot of decline in that, so we have that issue. Second issue being principal payments. We know that we used 179 a lot in the last 5 to 7 years. And a lot of those purchases were financed, which means we're making principal payments today, and we took all that depreciation expense in years past. So we're giving up cash for those two big non-deductible items, and so we might be looking at an operating note that's maxed out, but still have high taxable income.
If that income is low, how does that affect your tax planning?
So, it's been a while since we've had to think about these strategies of how to increase income rather than decrease income. But, there's things that sometimes we maybe just need to get a little bit out of our comfort zone again. And if you're used to deferring all your grain sales, maybe, making some plans now to start recognizing some of that income in this year. Again, getting that deferred income back into a current position. That's the whole point of what we did for the last 5 years of building those inventories. Now we got to reduce those. We may be looking at whether or not prepaids make sense, and is that discount good enough to offset the tax savings? And that's such an individual decision, so it's something that's real important to discuss with your tax advisor.
For people that might not be familiar with the tax planning of an agricultural operation, can you explain why even in years of very low profit margins, you're still not talking about losses here?
Yeah, and the whole goal usually with tax planning is to even that cash basis income out. So we don't pay the high rates in the high income years, and we don't see big dips in the low income years, because there's things like our standard deduction and personal exemptions that if we experience a loss and create a net operating loss, we don't get those things back. If we create a loss on Schedule F, which is where the farm income is reported, we may be having income that we could have received free from self-employment taxes in this year that we might have to pay on the next year. So it becomes a timing thing. In the way the tax laws work, we don't always get the same benefit by carrying back or using income averaging or any of those kinds of things. So it's important that we might manage those things.
For people that might have a low income number, what can you do to try and increase that?
We talked a little bit about bringing some income in. There's other things, maybe if we're not willing to let go of that grain, because that's, I think, another issue this year is that we're not really wanting to let go of that grain at these prices. We may be looking at using CCC loans as a way to generate some taxable income without letting go of that grain. We may be looking at, there's some other options with deferred price contracts that we maybe can use to do some things. So it's really important that we look at some of those kinds of options. There's also some non-farm things for those producers who put a lot of money into traditional IRAs in the last few years. Maybe we look at rolling that into a Roth so that we got that deduction in those high income years. If we got losses, we could potentially recognize that at zero tax, let it grow tax-free from here on out. So again, lots and lots of things that we can do. We just need to get you into that tax repair so we can get it done.
You can learn more about tax planning through Tina's recent Crop Watch article. Tina will also discuss the outlook for farm finances during the Market Journal Roadshow in November and December. You can find information about those meetings by visiting mj.unl.edu/roadshow. The October Nebraska Farmer says kochia is easily the #1 problem weed for crop growers in western Nebraska. This month's magazine says 2 years ago, Nevin Lawrence at the University of Nebraska-Lincoln's Panhandle Research and Extension Center began a USDA-funded study to explore different options to control herbicide-resistant kochia. The project is a joint venture between Montana State University, the University of Wyoming, and UNL. You can read more about their research in the October Nebraska Farmer. Cash rents for cropland in Nebraska dropped this year for the first time since 1999. According to USDA data, the statewide average of $196 per acre is $10 an acre cheaper than 2015. Similarly, cash rents for pasture land across the state fell this year for the first time since 2002. The most expensive crop ground lies in the northeast corner of the state. Farmers in Cedar County paid $324 for cash renting an irrigated acre. That's about 15% cheaper than 3 years ago, but 60% more expensive than 2010. Nebraska Extension educator Allan Vyhnalek will be part of a Nebraska Extension group conducting ag land lease workshops across the state in November and December. We recently talked with him about the meetings, but began by discussing land value trends in Nebraska.
From 2006 to 2013, we more than doubled land values in Nebraska, both for grazing land and for crop ground, because there's some good economic times with the higher commodity prices, especially corn and soybeans. 14, 15, and 16, commodity prices have dropped, so profitability's dropped, and guess what? Land values started to ease off, and so like a 2% one year or 3% one year, and this last year is about 5% statewide average. Not a huge drop yet, but it's starting to soften. So that's what's happening with land values.
Are you noticing that cash rents are starting to follow that trend and ease as well?
So it's interesting to note that cash rents depends on where you're at. Every neighborhood in Nebraska, as I do these meetings, I realize every neighborhood in Nebraska is just a little bit different. And so some neighborhoods are having a drop in cash rent faster than other places. Yes, cash rents are at least peaked and have started to soften, but they're not softening very fast, and especially not very fast for the farm economy on a per acre basis that we have going right now.
So if you're still negotiating for 2017 cash rents, give me some things that might be helpful for both sides to consider.
So as we think about renting for 2017, we want the party that pays the top rent, or do we want to rent our land to the party that we've done business with for decades in many cases? And that may or may not be the same person. So think about that first. Do you want the same renter, or do you want the top rent? That may not be the same thing. But here's some tips. For the tenant, this is a great year to make sure you have your communications right up to snuff. You have to visit with the landlord about what's happened, what the situation is, what the commodity prices are, what your cost of production is, and really show them, really demonstrate to them that the income just isn't there to support a high cash rent. And try and do the little things. Send a card at the holidays. Take them a plate of cookies. Get them out to the combine right now during harvest and give them a ride on the combine. Show them what's going on out there and explain to them what's happening. Get their grandkids out for a ride in the combine or a hay rack ride with the pumpkins and all that. Do something to do that. And then I think the other thing you have to demonstrate to the landlords is that you're doing a wonderful job of taking care of their ground, and talk about things like weed control, volunteer tree control, maintaining terraces, maintaining waterways, keeping everything mowed up nice, taking care of noxious weeds. So those are really important things to highlight as you have that conversation about leases, because it'll really make a difference in them thinking, oh yeah, I want to keep this guy.
You've talked before about flexible leases, flexible cash leases to be more specific. What are the pros and cons of those?
So a flexible lease is a little bit of a knockoff. It's a cash lease, so it's like a cash lease, but it's a knockoff of the old crop share, because you're actually starting to share some of the risk involved with that lease. So a flexible cash lease will usually flex either on price or yield or both. And the point would be that you're trying to give the tenant a break on a flexible lease if the price is lower or if the yield's lower, and you're trying to give the landlord a bit of a bonus, if you will, or extra money if the price or yield are higher, or both are higher. So that's the basic premise behind a flexible lease, and it's one of the things we'll be talking about at part of those workshops.
Yeah, tell me what people might be able to learn by attending them, why they might be useful.
So the morning parts in pretty much all locations are going to be our general landlord-tenant relationship meetings, or landlord-tenant meetings. We're talking about like land values, cash rents, good communications, good lease provisions, those types of things, good business arrangements. And then the afternoon in 6 locations, not all, but part of them, we'll talk about flexible leases. Some of the things I just got done talking about, and then some other considerations for flexible leases, like setting minimums and setting maximums.
You can find more about those ag land lease workshops through a link on the Market Journal website. Now, with this week's weather forecast, here's Nebraska Extension ag climatologist Al Dutcher.
Well, folks, here we again for the weekly forecast. During this last week, we only had one major precipitation event, and it primarily impacted most of northeastern Nebraska, with up to a half an inch, pretty common across extreme northeastern Nebraska. The heavier precipitation fell across northern Iowa. That was during the midweek period. But outside of that, pretty much warm and dry conditions have been the rule, and that's not unheard of at this time of the year, especially when you have a building La Nina event in the equatorial Pacific. The tendency is for the western corn belt to see a drier pattern during the fall harvest. That's exactly what we're seeing. The question is, how strong will this event be? And as we go to the the upper or go to the surface temperatures maps of the Pacific, we'll notice that below normal sea surface temperatures are starting to expand. We're starting to see some of that upwelling with the water that's about 200 to 300 meters deep of below normal sea surface temperatures starting to make its way up into the eastern Pacific. So we're starting to see this region starting to go toward below normal sea surface temperatures. And to the north, here's your main storm track recently with the storms coming into California and the Pacific Northwest, starting to churn the water up. So we're starting to see this region go to below normal sea surface temperatures. This all is starting to match up with what we would typically expect with a La Nina. So if that is going to be the case, we would expect stormy conditions to continue into the western United States. And indeed, we do have a trough currently in place in the western United States. Most of the energy shifting toward the northeast and being stripped by the mountains. So any of the moisture that does come over the east side of the mountains is not really laying out anything at the surface. And we'll see that trough tries to make its way a little bit farther eastward. The ridge starts to push toward the east, brings a lot warmer temperatures into our region. That energy starts to shift out as we go into the Monday time frame, but nothing in the way of any significant moisture, just not enough time for the moisture from the Gulf to get to the surface. And then we start to see that energy moving over to the Great Lakes. So benign conditions once again, but this another system that breaks off from this trough starts to make its way out during the midweek period, and that is expected to move toward the northeast. And this is the one that may bring a little bit of precipitation to western and central Nebraska, leaving eastern Nebraska at this point in time high and dry. And then we start to see more of a zonal flow as we get to the end of the week. In terms of how the precipitation will shunt out, notice the precipitation mainly concentrated in the western United States and some into the northeastern United States. So here's your heavy precipitation this weekend starting to make its way inward. That first wave moves out, brings that moisture to the northern plains, missing Nebraska. And as we get into Tuesday, we see benign conditions, but on Wednesday we start to see the signs of this system that's going to bring moisture up toward the north, starting to target the western and central portions of Nebraska, and then that clears out of the region as we get into Friday, and once again we look at a dry pattern reestablishing itself. Now in terms of the 8 to 14 day forecast, it takes us from next Thursday through the following Tuesday. We're looking at widespread above normal temperatures, although I believe that the western United States is probably going to be closer to normal to slightly below normal with yet another system coming on board. In terms of precipitation, you can see the impacts of that system is expected to generate itself out of the southwest next Wednesday, Thursday. It captures some of this moisture, and then we're seeing another wave that may potentially come in the Monday, Tuesday time frame, but overall a very dry pattern for most of the eastern United States.
Thanks, Al. Today's interviews can be found individually on the Market Journal website and through the Market Journal mobile app. They include information on corn and soybean prices, dairy markets, tax planning, and land leases. As always, you can keep up with Market Journal during the week by following us on Facebook, Instagram, and Twitter. Next week, Daryl Peel will look at cattle prices and beef demand. Until then, thanks for watching. I'm Jeff Wilkerson. We'll see you next week.
Join Market Journal online at marketjournal.unl.edu. You can also follow us on Twitter, Instagram, and Facebook. Promotional support is provided by the Nebraska Farmer Magazine, and major funding for Market Journal is provided by the Nebraska Corn Board. Market Journal is produced by the University of Nebraska-Lincoln's Institute of Agriculture and Natural Resources.